us. My name is Katie Kawauchi. I'm a program manager with the Intentional Endowments Network, and I'm very pleased to welcome three great panelists to share their expertise on this topic. Today we have with us Anthony Rust, who's the chair of the investment committee at the Warren Wilson College and an impact fund manager at BEI Business Equity Fund. We also have Justin Wilson, the director of the Diverse Asset Managers Initiative, and Julianne Zimmerman, the managing director at Reinventure Capital. The panelists will present for about 45 minutes, and the remaining 15 minutes will be dedicated to Q&A. So please enter your questions throughout the presentation in the chat function, and we'll try to answer as many as we can. This webinar is being recorded and it'll be shared with you by email and will also be available on our website shortly after. Before we dive in, for those of you who are not familiar with the Intentional Endowments Network, we are a peer learning network designed to support university and college endowments align their investment practices with their institutional mission, values, and sustainability goals. We advance peer learning among endowments in a variety of ways, including convening forums and events, organizing working groups, and facilitating information exchange through webinars like this one. We encourage you to stay engaged in these conversations after today's webinar, and we'll love to hear from you on what issue areas or topics you would like to see covered in future webinars as well. So with that, I will turn it over to Anthony, who will talk about what diversity, equity, and inclusion, or DEI considerations might mean or look like for an endowment.
Thank you, Katie. I'm happy to be a part of this discussion and important subject matter. Hello, everybody. For the next 10 minutes or so, I'll be speaking on the subject of DEI from an institutional investor perspective. I am a trustee at Warren Wilson College. Warren Wilson College is a small liberal arts college in Western North Carolina. Warren Wilson, we're located in the greater Asheville area. I happen to have the privilege of chairing the endowment fund, which is a endowment fund that's under $100 million in size. So from an institutional investor perspective regarding DEI, some years ago, we decided to restructure the endowment fund and change the risk profile from a much more aggressive, volatile endowment fund to a much more conservative endowment fund philosophy, similar to some of our peers of other endowment funds under $100 million. During that process, we made the decision to incorporate responsible investing throughout the portfolio. And part of that responsible investing philosophy was to incorporate DEI as a key component of that. So the DEI being one of those key factors, there's 4 components of DEI that we've incorporated or begun to incorporate it into the management of our endowment fund. The first area was incorporating DEI into the policies that guided the endowment fund. So from an investment policy perspective, we specifically wrote language into our investment policy that addressed our intentions around DEI. Specifically under our investment guidelines section, the language that we utilize specifically says the investment committee and the investment consultant will utilize a diverse group of investment managers that include managers of color and women-owned investment management firms. Under the strategy section that we utilized to achieve these goals, under a section called positive screens, we specifically wrote language into the policy that says investment managers who are investing in companies and investments that demonstrate a commitment to communities of color, diversity in hiring, executives and boards with respect to race, ethnicity, gender, and sexual orientation. So for us, it was paramount if we were really going to incorporate DEI throughout our portfolio, that it had to start and be intentionally written in the investment policy. The second component of our approach to DEI was the investment managers and the investment consultant. So our investment consultant is a majority consulting firm, but we insisted on, through our consultant, that they would have a team that would be reflective of the values that we believe should be key to a management of our portfolio. So not only on the account team did we insist that we have a diverse team of consultants, but we also looked deeper and asked them to report to us what members of their research team were men or women of color, what members of their marketing team were people of color, and then most importantly, on their investment committee and management of their firm, we wanted to get metrics on the number of people of color as well as women that our investment consulting had. And we use that as a baseline to start our relationship. And our investment consultant understands that DEI is a very important factor for us in the evaluation of their performance. So we on an annual basis, ask them to report back to us in terms of what progress they've made towards improving on those numbers. We then turn to the investment managers. We have approximately 12 investment managers across asset classes. Every search that we put out for a new investment manager, DEI, diversity of the investment managers that are selected is a key component. And so we're pleased to report that right now, out of the 12 managers that we have managing our portfolio, we have 2 firms of color, 3 women-owned firms. And we expect to improve on those numbers on an annual basis. So those are the first 2 key components for us in terms of incorporating DEI into the management of our endowment fund. The third component, which is one we are about to launch, is we're in the process of putting together a formal proxy voting and shareholder advocacy program. And under that program, we expect that one of those key issues for us will be diversity, equity, and inclusion, and advancing the values of our endowment fund to the underlying securities and the companies that we hold in our portfolio. And then the fourth component that we ultimately want to see is incorporating DEI factors that are woven into security selection by the underlying investment managers that manage money for us. So on the public security side, we believe that given our size of our endowment fund, that the best way to achieve our interest in seeing that DEI become a key criteria for the underlying managers that manage money for us is through the proxy voting and shareholder advocacy engagement program that we're about to launch, and working with peers who have similar values or would like to see similar factors incorporated into security selection by the underlying managers that manage money for us or our peers. The other side that we think we can have sort of a more direct impact is on the private market side. And so as we have approximately 30% of our portfolio committed to alternatives, as we go out to look for venture capital firms or growth equity firms or private equity firms or real estate firms, we have a much more, I think we have much more leverage in selecting which managers we want to manage money for us and ultimately where they invest that money in the private markets. Particularly a focus for us on the on the alternative side, private market side, is on the emerging domestic markets, which is, for some of you may know, it has been an overlooked area by Route 128, Silicon Valley, and there's real value, and there's studies that show there's real value in investing in companies in the emerging domestic markets. I think sort of the last thing I will leave you with, because I know my time is fast approaching, is that this is an ongoing journey. As I mentioned, we feel pretty good about the first two components that we've achieved with DEI, and we're looking forward to working on the third and fourth component. But key to this is an annual measurement of progress. And so our investment committee on an annual basis has charged our investment consultant, our investment advisor, with reporting specific metrics on where we're making progress, where we're not making progress in regards to these DEI factors. And Kate, I think I will stop there and turn it over to the next panelist.
Great, thank you, Anthony. We'll now turn it over to Justin, who will speak to us about DEI considerations when working with asset managers or investment consultants.
Lovely, thank you. Good afternoon or good morning, depending on where people are. It's a pleasure to be joining you all today. And thank you, Anthony, for talking to us a little bit about the institutional investor level. Again, my name is Justin Wilson. I'm a director here at the Raven Group, where we run a campaign called the Diverse Asset Managers Initiative, which is how I got involved with IEN. I wanted to talk a little bit about why we kind of started the campaign and why investors should work with diverse-owned asset management firms and diverse-owned investment consultant firms. So as Anthony pointed out, as he was kind of wrapping up there, he has taken it as his mission as head of the investment committee to track and report on these numbers in order to make them both concrete and to provide a metric to the numbers that he's working with in terms of the firms, and he's charging his consultants with that, right? So it's important that your investment advisory committees, your investment consultants are being charged with this from the investment committees that people sit on, because without these inclinations or somebody pointing to them that they need to do that, they won't undertake those endeavors. We've seen time and time again that those aren't things that they will choose to prioritize on their own. People will often go back to the wells that they're used to, and that can be anything from businesses that they've worked with a long time, businesses that have been passed down from investment consultants, senior investment consultants as they were junior and getting more familiar with the industry. So in order to overcome some of these biases, it's important that the investment committees, trustees, people who sit on boards who work with the investment consultants, charge them with doing better and making diversity a priority. At the Diverse Asset Managers Initiative, we found that the two most important things to us are also the most important things to the industry, and that's diversification and data. Diversification for us is a little bit different. We look at it as diversity in terms of the people, not in terms of a portfolio as one might traditionally look. But we think that with more diversity in terms of people, you'll get better results in your portfolio. And the data often bears that out. The other thing is data. We have found that there is not nearly enough clarity in terms of diversity in the field. It's hard to find out minority ownership, how people are defining minority ownership, and that's viewed anywhere between 25 and 49%, 50%, depending on which metric who is using in which field, and that can vary between hedge funds, endowments, private equity, etc. So it's very important to get as much data as we can on diversity to keep increasing those numbers. And again, it's not diversity for diversity's sake, but it's diversity for the best results for whatever organization you happen to be working with. In this case, it's endowments, but it could be hedge funds and other things. So in the spirit of both diversity and data, the Diverse Asset Managers Initiative a few years back began work with the Knight Foundation to commission a study, which they did with Harvard Business School. So a professor named Josh Lerner took the time to kind of demystify diversifying investments. And it was a study of ownership diversity in the asset management industry. So I'm going to walk through these slides for a few minutes briefly and tell you a little bit about the work that he found. And we'll be happy to take questions on it later. And then for those who are interested in seeing it, well, I'm happy to share both the slides and the report a little later on. But I wanted to kind of walk through it here today while we have people on the webinar. So a couple of things that really stood out were the fact that across industries, so across the 4 industries that they chose to take a look at, mutual funds, hedge funds, private equity, and real estate, minority-owned firms and women-owned firms did just as well as their counterparts. So that's, at the Diverse Asset Managers Initiative, that's one of the things that we heard often early on. It was either A, we can't find these firms, or B, these firms aren't doing as well as their counterparts. And so this study was very, very big for us in this industry to prove that they were out there and that they could compete at this level. All of the data that they were able to find showed that. They used databases like eVestment and hedge fund research to look at mutual funds and hedge funds, and then had to look at public and proprietary sources for private equity and real estate, where we're able to pull some data on there as well. Another thing that was pointed out is, like I said, firms are commonly considered women-owned or minority-owned if at least 25% of the firm ownership is held by female or minority individuals. I think on an investment level, people have to make a decision about what they will consider minority-owned, and that's for each organization currently to kind of figure out on their own. Some people will consider 25%, others will not. The field hasn't come to a conclusion on that yet, so that's important to point out. The next thing that's important along those 4 classes is that women-owned and minority-owned funds are in any of those industries, again, mutual funds, hedge funds, private equity funds, or real estate funds, are never more than 6% of the industry in terms of the asset managers. And in terms of assets under management combined, they're never more than 5%. So that's a glaring issue for people who are doing just as well. And it kind of shows how they're being held back in terms of the assets that they're allowed to manage. Another thing that's super important to point out is that the assets under management for women-owned firms and minority-owned firms often come from public funds as opposed to sub-advised funds or high net worth individuals. It's often public funds where they're going to be getting their money. So the opportunity to work with more endowments is critical to their continued growth. So that's a quick overview of some of the findings of the Knight Foundation. Again, the metrics and kind of the biases are all included in that report, which we're happy to share afterwards. The next thing that I wanted to talk about is the metrics for assessing diversity and inclusion. Those fall directly in line with how the field is being looked at generally. So in assessing diversity and inclusion, like I said, there's 25 to 50% as a threshold for what diversity is going to look like. But inclusion is going to have to come from the investment consultants, including people in this survey. And one of the things that we've also done at the Diverse Asset Managers Initiative is a survey of the investment consultants' diversity internally. We did this under the premise that if they weren't diverse internally, that they would be less likely to try to find diverse consultants on the outside. So that report should be coming in the next couple of months. We've had to push it back a little bit because of some delays in getting the data, but we sent a questionnaire to 20 of the top investment consulting firms. And we used that data to ask them about their research staff, about their senior management and ownership, men versus women in terms of ownership, the diversity numbers in there. But it's important to, again, get this data, and whether that's via questionnaires, whether that's via surveys. I know IEN has talked about possibly doing something as well, but it's all about getting as much data on diversity and inclusion and it's not to shame people, but it's to show people how they could be doing better, and then to provide them with the resources that where their blind spots may be. So it's important that we look at where people are starting out. If it's 2 women-owned firms and 3 minority-owned firms that you're working with, that's great. How can we grow that number in order to diversify your entire portfolio and to get you the best results? And so we encourage everybody to start tracking and reporting their numbers. And we believe that a culture of tracking and reporting will be the tide that lifts all ships, in terms of letting everybody know, okay, here's who I've worked with. Here's how we're making diversity a priority, and here's how we can continue to grow in order to provide the best returns for who we're working with. So I don't want to take up too much of my time. I will kick it over to Julianne, but thank you so much for allowing me to be on here today.
Great. Thank you, Justin. Julianne will offer the final perspective on thinking about DI when selecting companies.
Thank you very much, and thank you all for joining today. As you just heard from my 2 esteemed colleagues, as we sort of drill down, there are layers of perspective to bring to bear here. And our perspective is that of an impact and return venture practice. IEN Venture Capital is an impact venture practice. So we see a large, robust patent investment opportunity specifically associated with the DEI realm. And so I'm going to spend the next few minutes exploring with you quickly to see whether you might see the same things that we see in terms of opportunity for significant investment. Next slide, please. So starting off with just sort of setting the frame, you may or may not be familiar with these numbers, but over the last 10 to 20 years, several studies have been done that have surveyed the venture community, the landscape, and have found that over that period of time, less than 1% of venture capital investment has been made into businesses founded and substantially operated by African Americans. Next, it's less than that for Latinx founded and operated companies. It's slightly better for women, 6% or less, which is up from 2 or 3 a few years ago, but still very paltry compared to the population of potentially investable companies. Next, and intersectionality is a real issue. The team at Digital Undivided and others have looked at, for example, the amount of capital flowing to specifically Black female founders, and it's negligible. It's essentially 0. A few years ago, the number was 12. Black female founders had raised $1 million or more from the venture community since 2012. That number has recently shot up to 34, which is still essentially 0. Next slide, please. But we don't see this as necessarily solely a question of justice or fairness, although it for sure is that. Rather, we see it as posing a very serious systemic question of whether these numbers signify a market working rationally and efficiently to accurately price talent, opportunity, and risk. Next slide, please. We hear our colleagues make these comments routinely. We have a pipeline problem. There isn't enough investable talent. There's a shortage of high quality deals. You may also hear those comments routinely. Next slide. We don't necessarily, we don't agree at all, in fact. And moreover, we don't believe that this set of figures, this persistent, steep inequity, asymmetry in access to capital represents a properly functioning market. We believe that it represents a significant or even a profound market dislocation. Next slide, please. And we see for our part a very, as I mentioned at the top, patent robust opportunity set in the form of entrepreneurs of color, female entrepreneurs who are starting and growing meaningful businesses with the potential to become highly profitable enterprises at scale. And for a whole host of reasons, those are simply overlooked by the mainstream venture community. Next slide, please. We see coming through seed stage and pre-seed stage and academic and peer and industry-based groups, literally hundreds of teams looking for capital at the growth stage where we focus, and really finding none interested in them. Next slide, please. So for us, this frames up both a moral and an economic imperative. So we know from research done by McKinsey and others that over the last 20 years in the United States in particular, but not only in the United States, young growing companies have accounted for most or all of job creation and most or all of wealth creation. While during that same time period, as we've just reviewed, the overwhelming majority of capital has gone to a very narrow subset of founders and their companies. That is essentially a driving mechanism which by no one's fiscal policy or economic strategy has really accelerated and exacerbated the financial inequity that the World Economic Forum has designated a primary threat, the top threat or one of the top threats to global economic security. Next slide, please. And the good news about that, so at Reinventure Capital, we talk about the bad good news. The bad good news is, as you've just heard, the good news is that where there is a market dislocation, there is concomitant opportunity for investors who recognize that dislocation and who take note of the opportunity. So where the market is not accurately pricing talent, opportunity, and risk, investors who do stand to gain. Next slide. So our theory of change and our impact objective are totally aligned. We also note with interest that Kauffman Foundation and Silicon Valley Bank, in a survey they conducted a few years ago, noted that small funds and many of our peers, investors who are focused on these overlooked founders, are in this category of $250 million or less. Small funds actually routinely outperform their larger peers. And so not only is the investment opportunity a very good one in the field, but as you're looking at managers with this investment approach, you really should expect that they would have quite good figures to report. Next slide. And so we believe that taking all of the data into account and echoing my colleagues' comments about the importance of data, taking that data into account, we believe LPs should expect managers to deliver both impact and return. And that managers specifically who are looking at these factors are poised to deliver both. Next slide. The Reinventure approach specifically is at early growth stage. So we invest in companies, as I've mentioned, led by and substantially controlled by people of color and or women, companies that are at or about break even and poised to grow profitably. We believe that it's very important to focus on those companies that can become economic engines. We look for companies in fragmented markets, frequently taking advantage of shifting conditions, whether those are technology or demographics or use case or regulatory, what have you. And as a result, are poised to become really market leaders in their segment. And we work with them to encode and make sure that we commit together to equity at all levels. So we're not interested in companies that have 1 or 2 people of our target populations in management, but we want to see a company which hires, promotes, and compensates equitably at all levels, top to bottom. And we want to work with them to also bake in their own impact objectives. Many of the companies we're interested in are in sectors, education, healthcare, finance, infrastructure, etc., where they have created these business models specifically around impact objectives of their own, and we bake those in our agreements with them. Next slide. We focus at that early growth stage specifically because, again, we see that there's a gap there. There's nowhere near adequate capital available to our target founders at any stage of development, but we see that where that capital is flowing well, it's primarily concentrated at the pre-seed, seed, and startup stages. And so we focus at that early growth stage where we can help to complete a trajectory for these companies to, again, become profitable enterprises at scale. Next slide. We believe that this approach is just fundamentally better all around for LPs and founders than the prevailing venture practice. We use a mix of equity and debt to further benefit founders by preserving equity and wealth creation within the companies, and preserving the widest possible array of lucrative exit scenarios for them and for us, and providing a downside protection for our LPs. We believe that this aligns all of our interests collectively on achieving, again, impact and return as our definition of success. Next slide, please. So I'm very privileged to work with Ed Duggar, my senior partner, who is a veteran in this space and a pioneer impact investor who really wrote the playbook we are pursuing in his former fund, UNC Partners. UNC not only met or exceeded all of its impact objectives, but returned 32% IRR. And so again, impact and return as inextricably connected in our investment approach and strategy. Next slide, please. For my part, I'm very pleased to be working with Ed and bringing from my background a wealth of very different approaches and perspectives from the prevailing venture community, but having grown up, so to speak, in the innovation sector or innovation realm, I'm personally quite interested in working with teams to help them to figure out how to become consistent, sustainable, long-lived value creators in the segments in which they operate. And that covers it for us. So back to you, Katie.
Fantastic. Thank you so much for those wonderful presentations. For our panelists, if you can go ahead and take yourselves off mute, we'll jump into our questions. And for our audience, please continue to type your questions into the chat box and we'll answer as many as we can. So to kick off the Q&A, there are a number of questions coming in regarding measurement standards. And Justin, I know you mentioned some of this, but this question is for all of the panelists. How do you go about selecting and developing these DI metrics? What other metrics are you looking to track, and how do you measure success? And for Justin, can you additionally talk about why you chose the 25% threshold for ownership? So maybe we can start with Anthony and then just move from Anthony, Justin to Julianne.
Sure.
Anthony, I think you have to take yourself off mute.
Hi, Katie.
Yes,
Can you hear
we
me?
can hear you now.
Yep. So, we have tasked our investment consultants with developing proprietary, measurement standards for how successful or unsuccessful we are on an annual basis in achieving the desired goals under our responsible investment policy. There's no industry standard or third-party metrics that we utilize. But so we basically have developed a proprietary measurement standard that's suited specifically for our endowment fund in terms of how well we're doing in relation to number of firms of color that we're hiring, specifically under that, number of African American firms, number of Latino firms, number of women-owned firms, number of Asian American-owned firms. In regards to the underlying factors of the number of people who are working on our account, whether they're men or women of color, that sort of also depends on the asset class that we're investing in. So there's a number of variables, but so that's how we've approached it. But it's a proprietary measurement tool that we've developed specifically for our portfolio.
Hey guys, it's Justin. I'll try to follow up, and Katie, help me answer these questions. I can't see the questions generally, but I'll try to answer based on what you said. So the first thing in terms of how we're going about assessing the data is the Diverse Asset Managers Initiative is solely focused on getting diverse asset managers in place, right? So we work with trade associations and other entities to provide names to endowments or pensions or whoever might be looking for diversity in order to get that out there. But we consider ourselves a non-interested third party. We provide lists based on what they're looking for, and then we leave it to them. But I do want to point out that we did see with one entity that we worked with that they had started an emerging/diverse program. And emerging and diverse is a whole nother conversation, probably for a whole nother webinar. But one of the things that they did was, unfortunately, the program wasn't providing the results and the returns that they were used to seeing. And because of that, they kind of scrapped the whole program, made it a point to not necessarily continue working with minority managers, and then began a focus on gender diversity. And because of that, they weren't taking into account the relationship that they were having with minority managers, and they weren't trying to quantify that in certain ways. So I think people want this to be a quick fix. They want to look at diverse managers, hand them something, expect them to have the same business relationship that they've had with previous managers, that everything will just work out normally. And I think that there's some nuance to working with diverse managers and just with different managers than you might have previously been used to for the past 20 or 30 or however many years. That takes some getting used to and some figuring out. And a lot of that is probably more suited for a Julianne to tell you in terms of like the different types of assets under management, or the different types of products being used to generate returns. But if you don't work with them in terms of figuring out what they do best and then utilizing what they do best to get your returns, you'll suffer. The next thing that I'll point out is, from the Diverse Asset Managers Initiative's perspective, we consider 51% ownership by women or other minorities to be minority ownership, but we do understand that that's not the industry standard, and the industry has not yet settled on a standard. Again, we've heard everything from 25% to a third to it has to be 51%, and different investment consultants or different entities will require different things. So it's important to know when you're making the request as somebody who might be sitting on an investment committee, a la Anthony, What are you asking for? When he says he has 2 firms that I think are managed by women and 3 by minorities, are those 2 firms managed by women 100% female owned? Are they 51%? Are the 3 that are minority owned? Is it 25% minorities? And how is all that being counted? It's important to know, and it's important to drill down on these questions so you have that data and you have your starting point. It doesn't have to be perfect. It's important to have the starting point and to keep making progress to a better tomorrow.
And just to follow up specifically for Warren Wilson, we use a 51% ownership as the baseline for determining whether a firm is minority owned or women owned.
Very important to know. Thank you for sharing that. It's definitely important metrics, and people may push back in some cases. You might have an investment consultant that says, hey, I wasn't able to find a 51% firm for a particular fund that we're raising, but there is a firm that has a managing director who's one of 3. And you guys have to make the decision, is that okay? Is that enough? Do we feel like that's representative of diversity in these spaces? Or no, we were going to keep fighting for more because we think that there's another firm out there who can do the same thing that is diverse owned and will generate the returns that we want to see.
So just to provide a kind of a different axis of consideration, when we're looking at companies, one of the concerns that we want to take into active account is what's the appropriate level of ownership when we're talking about venture-backed businesses. And so what we have seen in our experience is that, for example, if you apply a 51% ownership requirement on the companies, then that really limits their ability to take in outside equity capital. Of course, the part of the reason that we use a mix of equity and debt is because we actually want to preserve ownership as much as possible in the hands of the founders and their teams. But we look at a very real trade-off there, to work with the founders to make sure that they retain significant and controlling ownership, but that they are able to access equity and debt efficiently in the ratio that is most appropriate to help them to grow a successful business. And so we don't have a set number that we look for. Rather, we look for indications of who has decision-making rights, who has authority, who has a stake in the equity pool, and is that an appropriate stake for the size, the industry, and the capitalization of the company.
Great, thank you. Another question is related to data. So where do you find reliable and quality DEI data? And do you have any recommendations for investors looking to learn more about this? And feel free to jump in, anyone who has an answer to this question.
This is Julianne. So we see that, as you've already heard from Justin and Anthony, there's really not sufficiently complete or robust data available in the way that there is for other factors. That said, we are starting to see some really good material come from, again, groups like Digital Undivided, as I mentioned, with their Project IEN report, which is outstanding. We've seen a really interesting report come out this year from Harlem Capital and others. What we've also seen Cornerstone Capital, for example, begin to put out some summary analyses on these factors. What we would love to see for our part is for someone to really take a comprehensive or a meta view of the whole sector to say, really, what can we say about where capital is flowing and what kinds of returns people are requesting or expecting, and what kinds they're actually seeing, and where do we see gaps or obstacles or opportunities. And if anyone on this call is in a position to do such a research project, we'll be happy to lend whatever assistance we can to pull that together, because we see that it's very often a significant stumbling block for particularly institutional investors to not have that kind of resource to lean on. And so we're keen to do whatever we can to help bring along the state of analysis and reporting in this sector.
So I'll add to this. So the National Association of Investment Companies, NAIC, put out a piece a few years back on the emerging domestic markets, and highlighted statistics on the value of the value of finding businesses, good investment opportunities, venture capital, early stage, as well as growth equity investments in communities of color in the United States. And this sort of follows along with what Julianne was saying earlier, right? So there's, as several folks probably on this call know, right, there are several components to driving increasing enterprise value of an investment from the VC community, right? So, but two of the primary drivers of returns are entrance value, entrance price, and exit value. And in a dislocated market, as Julianne said, like the emerging domestic markets, right, there are pricing inefficiencies that early stage or growth equity companies can have by investing in the emerging domestic markets, right? And so while Route 128, Silicon Valley are fishing in the same pond and driving up pricing, right, because they're chasing the same deals, there's little attention being paid to the emerging domestic markets, where from a pricing standpoint, you can get a terrific entrance value on growth equity companies that are being overlooked, and there's not a lot of competition, right? The same institutional capital that invests in the same VCs and the same growth equity companies, right, are also investing in the global emerging markets, where the geopolitical risk and currency risk is a lot greater. So the risk profile of a portion of a traditional institutional investor's private equity portfolio is increased by investing in the global emerging markets, but disregarding the emerging domestic market. I'm happy to send around that report that NAIC put together for after this call for those who are interested.
Great. And can each of you talk more about linking DEI considerations to alpha generation? So in other words, is there a business case for this type of investing, and what research is available on this? And how can investors communicate the impact of these strategies to stakeholders?
So I can just speak to Warren Wilson's performance as we've adopted our responsible investment policy 5 years ago, and this is our performance is not by any means driven solely by the DEI factors, because there's a number of other factors in our responsible investment policy. But for the past 5 years, we have been a top quartile endowment fund in regards to performance relative to our peer group.
So similarly, what I would add to that is, in addition to the indicators you just heard from Justin for why systemically or structurally there's alpha advantage to be captured. I would just reiterate that Ed Duggar's former fund pursuing this approach delivered 32% IRR, which was top tier performance for any venture strategy of its vintage. And we don't see any contextual or structural differences in the market today that would indicate any reason to downplay that return or expect it to be substantially different.
I would also add that of the 3 out of the 12 firms that we have in our portfolio that fall under our DEI category, 2 out of the 10 are in the top. One is in the top decile of performers relative to their asset class, and the other is in the top third. And the third is in the top 50% of investment managers in their asset class.
Yeah, just to kind of button all of that up, as was kind of pointed out in the Knight Foundation study, they do just as well. Obviously, they're going to minority-owned and women-owned firms are going to have to look towards different resources and kind of build themselves differently than their counterparts. And I think that that's just a natural thing with the way of thinking. But I also think that it's important to note that given the incredibly small numbers, I'll quote John Rogers of Ariel Investments, many of these people, these men and women who are undertaking these asset management firms are the Jackie Robinsons of their field. And that's to say, they have to be incredibly good at what they do to even get in the door. It's really hard to build your brand and to build the assets under management that you can have as a minority-owned or women-owned firm without being really, really good, because the door will shut on you, as I mentioned previously, very quickly if you're not. And so I think that they're always thinking of diverse ways to create the returns that people need to see to keep themselves in business. So I think it's important to note that they are often very, very talented, and as Julianne pointed out, often overperform in comparison to their peers. But again, they're not perfect. It's not a perfect system. Every asset manager that you select, Black, brown, male, white, women, or otherwise, won't always get you the returns that you're looking for, but they do very well. And they have to do very well in this field.
Great, thank you. And I think we have time for 1 or 2 more questions. The first one being kind of the main challenges you've encountered in advancing your work in this field. It's a broad question, but if you can tackle that, that would be great.
I'll start, and it's probably the overarching theme of today, but there's just not enough data. There's not enough tracking and reporting. There's not enough people doing what Anthony is doing well, which is being able to say, here's our returns over the past however many years, here's who we've hired, here's how they define minority, here's the answers to all of these questions that will help guide everybody else. There's not nearly enough tracking and reporting in the field to push the field to publish these numbers. And it's really contrary to what one would think, given that it's such a data-driven field, but the numbers are not nearly robust enough to be able to spot the trends and to spot the best practices and to really develop theories and practices on how to be good at this.
Yeah, I would concur with Justin. There's not enough widely accepted industry data on the space. There's not enough research being done. I'm glad Julianne brought up Cornerstone, because they're doing some interesting research on the space. But I think it's a sector of the industry that's going to evolve, similar to the way ESG a dozen years ago was just sort of on the fringes. ESG is now a major metric that underlying companies are measured on, which investment managers take into account before they select to buy or sell their stocks and bonds. So I think the goal, particularly for Warren Wilson, on our proxy voting and shareholder advocacy, is to push for the industry to recognize, and big companies to recognize, that DEI factors are critical components to value add. You know, I'm not sure how many folks read the recent BlackRock article that came out earlier this month, which really highlighted that, you know, diversity, whether it be cognitive or experiential, improves problem solving and creativity and leads to more innovation. And there were metrics in that article which talked about the increased number of patents or in citations under an R&D perspective that were created in companies that had, you know, a higher representation of female directors on their board of directors. So I do believe that you will see more and more research out there, more and more statistics, and hopefully we'll get to a point where we'll have some sort of widely accepted industry standard. And I think calls like this are helpful to advance that agenda.
So if I could just add one more note to that, I want to second everything that Anthony and Justin have said, and reiterate that you know, one of the ways that we will get to that data is to have quite a bit more discussion like this, with people sharing actually what they're doing. And so I especially appreciate that Anthony's willing to disclose that. And also, we also know that even among institutional investors who have declared a desire or an aspiration or even a mandate to increase the DEI representation in their portfolios, the processes and criteria and decision-making structures in place very often eliminate exactly the managers they're seeking to include. And so I would encourage everyone on this call to look at your selection criteria and requirements and examine whether some of them may inadvertently be preventing you from bringing aboard incredibly talented, high-performing managers, either because of you know, experience requirements or track record requirements or size of fund requirements that they simply cannot meet and will not be able to meet. And so to the extent that you have the ability to experiment with your methods and your processes, I encourage you to give that a try and talk with colleagues like Anthony about how they've gone about making their adjustments.
Well, thank you, Anthony, Justin, and Julianne, for this excellent discussion. And also thank you to all of our participants for joining us. If you have any questions about this webinar, the work of our panelists, or any activities happening in the Intentional Endowments Network, please be in touch. And again, this webinar will be up on our website shortly. Thank you again, and have a great afternoon.
Thank you.
Thank you all. Thank you, Katie.
Thank you.